Well, welcome everyone to today's webinar titled The White House and the Fed, Market Perspectives Going into Year End. This is Brian from Strategic Treasurer, and we're pleased you could join us today. Our speakers for today are Deborah Cunningham, Chief Investment Officer, Global Liquidity Markets, Executive Vice President at Federated Hermes, John Mosko, National Sales Manager, Liquidity Management Division at Federated Hermes, Phil Orlando, Chief Market Strategist, Head of Global Investment Directors Team, Senior Vice President at Federated Hermes, and Craig Jeffery, Founder and Managing Partner of Strategic Treasurer. Welcome, Debbie, John, Phil, and Craig, and I'll now turn the presentation over to you.
Thanks so much, Brian, and it's good to see you, Phil, John, and Debbie, once again.
Thank you.
Hey, Craig.
Great to be here.
Yeah, there's so much to cover today on the White House and the Fed, and in our review sessions, I just felt like I was getting quite the education. But let's go through what our agenda is for today, what you'll be learning, what you'll be hearing about from Federated. So on the money market funds, we'll look at some of the key issues, some of the things that are happening on the money market funds. We'll look at investment potentialities, some of the changes that are taking place. What does that mean? On the Fed sentiment side, we'll dive into some of the member views and what are some of the implications for that. Then on the economic forecast, we'll hear from Phil and hear a little bit more about GDP, the economy, best case look from Federated Hermes outlook, which I think you'll find extremely interesting and useful. And then on the examining the markets, there'll be a look at equity, cash, fixed income. Finally, for the key takeaways, that'll be a more free-ranging discussion between Debbie, Phil, and John. So let's get into it. Debbie, we'll pick up with you first on some of the key issues. Could you highlight what you think is essential for anybody in the corporate investment space here?
Absolutely, Craig. And, I think what we list here is just numerous factors that we will weave into our discussion over the course of the next 45 minutes or so. Hopefully, adding some value as to why and how they fit into our discussion around what's happening from, an administration and a White House perspective, as well as certainly where they fit in the grand scheme of things from a Fed outlook and, an interest rate expectation. Not the least of which is, Liberation Day and the tariff effect. It seems like it was a long time ago, 8 months or so ago, but there's still a lot of impact that's going on in the marketplace today. Maybe not as drastic as what it was initially thought of, but, tariffs is still an important component of our discussions from a key issue standpoint. More recently, with the government shutdown and now reopening, data integrity, number one, lack of it at all from a data perspective, for the longest government shutdown in the history of the U.S. And now that we have it and it's starting to flow in, how valid and correct is it? And is it out of date? I mean, we just received the September jobs data today. That's almost ancient history in the context of, what we usually deal with on a data basis. We saw key rate moves by the Fed from a 25 basis point cut per meeting in September and October. There were some dissensions given what's going on with changes that will occur, and we'll talk about that in the makeup of the FOMC. There will be questions going forward about Fed independence and the politicization of the Fed. We also successfully saw a end to basically the debt ceiling debate that resulted in $5 trillion of excess room from a debt ceiling standpoint, and just huge amounts of supply that came into the market from a treasury perspective in the third and now continuing into the fourth quarter, providing good opportunities for those of us in the money market funds. We're going to talk also a little bit about the wave of the future and what might be coming down the road for our sector of the market, for the market and the funds market in general. Those include digitization, tokenization, stablecoin types of discussion. And then, overall, what I think a lot of people are interested on in this call from a Fed perspective anyway is where we're going from an interest rate standpoint. So if we go on to the next slide, we can talk about at least the beginning of this in a little bit more detail. If you looked at the second half of 2025 versus the first half of 2025, it's also it's sort of like it was a tale of two halves. The first half had strong hard data from an economic perspective, soft and weakening soft data. That started to reverse itself to some degree in the second half of the year with some of the harder data, especially along the employment side of the equation, starting to turn a little less steady, while some of the sentiment and outlook soft data types of information in the marketplace began to strengthen. You saw, as I mentioned, a 25 basis point decline in the Fed funds target range in each of the September meetings, which brings us to a range today that's in the 3.75% to 4% target range. And you think that, okay, those two meetings must have gone very similarly. But if you viewed the press conferences after the September meeting versus after the October meeting, there was a distinct difference in tone by Chair Powell. His confidence level, his calmness level, his concern about data integrity or missing data all took different turns in the September meeting versus the October meting. Data integrity questions for the non-government piece of information abounded. There was significant revisions that had just been received in the July timeframe. So now, after October, no data and a softening labor market going into when the data deluge started, or the absence of data started, really, I think, clouded what was happening from a September and an October meeting standpoint, even though the outcome was essentially the same. So this slide is showing you what Fed funds futures is predicting for the shape of interest rates going out into 2027. And essentially, it's showing you that by the early part of 2027, we will see short-term interest rates with a 3 handle on them and a terminal rate that's somewhere in the 3 to 3.5% range. So basically, what we just received today, September payrolls information, should have been out, the first Friday in October. We got it today. Was a bit of a reversal of the August, the very low and abysmal August numbers that we saw. In the September release today, we saw a growth in jobs of 119,000, and yet we also saw the unemployment rate tick up a percentage point from 4.3 to 4.4%. So maybe call this neutral, positive on the jobs creation side, negative on the unemployment rate side. Suffice it to say that I think if the committee, the FOMC, had that data back in the beginning of October, and they would have been using that as their most current data for their October rate decision, I believe they might not have moved rates another 25 basis points. It would have given them a little bit of cover from an employment perspective to have a little bit more time facing what I think that the committee members think of as the more pertinent problem at this point, especially from a tariffs and immigration standpoint, which is inflation. However, that didn't happen. We just got the data today. But what I do think this will produce is certainly a more divided Fed than we've had ever in, since the Greenspan era, as we approach the December meeting. And from my own personal view standpoint, I've, kind of flip-flopped today based on this information, what I thought was a 60-40 chance that they would decrease rates by another 25 basis points in December to something that's more 40-60, with the more likely scenario being that they hold rate and take a pause as we go into the December timeframe. 2026, we're still looking at 2, maybe 3 cuts, and then basically the same terminal rate that we've been calling for, 3 to 3.5%, but extending that into 2027 or so, then getting to that point in 2026. So, that's kind of the state of where we are today at this point. We want to move on. We can talk a little bit what that means for various sectors within the liquidity space.
Yeah, thanks for all that. We're going to pop up our first polling question combo. So that should be on your screen. There's instructions in the chat box. Both of these are multiple choice. Select all that apply. The first one's which policy related risks are most likely to affect your liquidity or investment strategy. The second one is your borrowing strategy over the next 12 months. We got investment at the top, borrowing at the bottom to see if there's any distinction. So select all that apply in both of those, hit submit, and then we'll be ready to go. And I'll just point out, once you've done that, I'll give everybody a moment and then I'll give some additional instructions. All right, so we have the answers. I'm going to just ask a question, and if someone looks eagerly at me, I'll point it to you, Debbie, Phil, or John. The top one on the investment side, number 1, interest rate path uncertainty is the biggest one to impact liquidity, followed at a distance by market volatility tied to fiscal policy. Who wants to ask? I see John looking at me. I see Debbie looking at me.
Fine. Yeah.
Why don't we start with John, and Debbie, if you're wanting to go after that, just jump in right after John.
Well, I think and good afternoon, everyone. I think good to be here. I think Debbie's comments sort of echo the responses to the poll question, right? So, if there's anything that has been pretty clear about this Fed chairman and his term and the governors that vote, it's they've kept the markets on their toes. What the pundits, if you will, and Craig, we talked about this with Sue on the podcast, silent plug, that I think that they've kept the markets on their heels, and what the pundits have thought might occur doesn't really materialize. So it completely makes sense that there's concern about the path of interest rates going forward in terms of making their investment decisions.
Yeah, it seems very straightforward. I agree with you, John. What determines our investment strategy today? It's basically, both monetary policy and fiscal policy, and that's what's showing up as the 2 key top components in this poll.
All right, I'm going to close it down. There are 33 more people who answered the investment side than the debt side, just as a point of reference. Yeah, now we're going to jump into investment spotlights, Debbie. Maybe you could talk us through this. We've got government, credit, and unis. Talk us through what we should be thinking here.
Sure. Just to give you an idea, we have a committee that, kind of determines what our investment highlights will be along the yield curve in the discussion and information that we provide to clients on a regular basis. And that committee is called our STIC committee, Short-Term Investment Committee. The investment spotlights that you're looking at on this slide are the output from that committee. The committee members and the voting members of this committee are portfolio management teams from both the liquidity side as well as the short-term fixed income side. And what we're trying to provide on a thought and investment piece is for our clients is looking at the 3 key types of products that we manage along the yield curve: government, prime or credit, and tax-free or municipal. And then looking at the types of products that we're talking about in that 3-year and under space on the yield curve. So money market funds, micro short funds, ultra short funds, and short intermediate funds. We're trying to highlight where, depending upon our own outlook and what is happening in the marketplace, we think there's the best value along this, investment spotlights box of 12 different boxes, one of which is empty because we don't have a micro short government product. But ultimately, giving you, sort of our best ideas and our best thoughts as to what in the current market environment makes the most amount of sense. And like I said, we have monthly meetings. We compare our own output to the Fed's dot plot to see, how much in alignment or how, very different we might be along our thought processes for when and how much the Fed will move rates in the future. And then depending upon our success with that, what that means in the context of this grid and how it should look from an investment perspective that we would recommend, from a client standpoint. So, sort of looking at it in the current market, money market yield curves are very flat. We could buy repo at a 390. I could buy 1 year at a 390. Our yields are anywhere in the 4 to 415 area. We've been keeping weighted average maturities long, and depending upon whether you are a day like today when the market is not expecting the Fed to cut in December, or a day like 2 weeks ago when the market was expecting the Fed to cut in December, where we have continuous good relative discussions as to what looks like the right thing to buy on any given day. Where that has, sort of left us from a product perspective on what we think offer, at least in this current environment, the best value. If you look at the far left money market sector of boxes under the credit component, what you'd see here would be our prime money market products. And we think these are kind of the best value for customers at this point. They're still, in the low 4% from a return standpoint. Obviously, they're a steadily priced product, so you're only seeing return from interest, not necessarily appreciation or depreciation of price. You're also seeing the highest quality credit associated with non-government entities in this type of a product. So when you think about, Jamie Dimon, cockroach theory from, a credit markets perspective, that's not the credit markets we're talking about in this type of product. We're talking about high quality, minimal credit risk types of issuers that we're using in that sector. We're then looking at, if you look at the very top row on the government side, Govy ultra short and short intermediate government also offering excellent value in the current environment with what I'd call very substantial yield, somewhere in the 40 to 80 basis point range over the government money fund product, with a play from a standpoint of Fed outlook and what that might mean from a price differential going forward, still being pretty positive given the high amount of income that are being earned within these portfolios. So at this red hot moment in time from, our most recent meeting, the investment spotlights portion that we provide is highlighting those three sectors at this point. That could change easily next week, next month, next quarter, but that's where we stand right now, Craig.
Great, thanks. And that we're going to shift over to tokenized money market funds, the difference between traditional and tokenized. I think John's going to lead us off on that one.
Thanks, Craig. I think if there were probably another topic that probably top of the stack for the 2025 relative to the Fed and their policies, it's this. It's if you think about tokenized money market funds in the context of just digital ledger technology, blockchain technology in general, this is probably one of the most talked about topics in the liquidity space for 2025. And why so, I think, is finding using 21st century technology, the blockchain technology, finding applications for liquidity products. And I think as the markets evolve from whatever it was to wherever we're going, this looks like the logical path. And as we're going through what we would call proof of concept, there are tokenized money funds out there that run in conjunction, sort of a belt and suspenders with the actual 40 Act product that you transact today. And slowly we're making small incremental steps towards transacting a money fund in a blockchain type technology. And the advantages, while still sort of being proof of concept out, but there are some, there's, as you point on this slide, one of the main things is transferability. A money fund isn't a bar of gold. It has to be purchased and redeemed. And having something on a digital ledger technology, you've created portability. And so I can, if I don't, without any, using Phil's good word, deleterious effects to the fund. So if I have to redeem a large chunk and then repurchase it, that cause effects to the fund, whereas I can just transfer it to someone, whether it's a payment or transferring collateral ownership, the effects are not at all. So there's one, faster settlements you have here, uh, which I'm not necessarily sure if that's a positive or negative, candidly. I think sometimes checks and balances are good, especially when we're talking about a $8 trillion franchise in the marketplace. But it does allow for instantaneous transfer of ownership and peer-to-peer transfer. So I think, and we can kind of go through each one uh, individually, but I think the bigger picture here is that technology is making its way into the financial markets just incrementally, step by step, and this is just one way. Will there be an embrace by the folks on this webcast? To be determined. Concurrent with that, Craig, is also the entire stablecoin market. So if we want to look at tokenized money funds in conjunction with cryptocurrencies and alternative trading systems, as the cryptocurrency market evolved, so did let's call it the area to hold your cash while you were not involved in as an owner of a cryptocurrency. And the stablecoin product was evolved, and it's continues to get larger and larger and larger and dominated by two. But in the current administration, their embrace of blockchain technology, of cryptocurrency trading, created a more structured way for stablecoin operators in the United States to operate, which is called the Genius Act. So we're still probably 18 months away from implementation. Nevertheless, liquidity providers are working on solutions that would make things Genius compliant. So all of these things are exciting. It's a next step in evolution to our marketplace, but at the same time, still evolving in the proof of concept. Earlier this year, Bank of New York, through one of their distribution platforms in conjunction with Goldman Sachs, has now a tokenized platform, which is again working in conjunction with their 40 Act products, and it is to be seen whether this is a effective use of a tokenized money fund. But again, we're in the crawl phase, and we're not sure what inning we're in. But clearly, there are use cases where we're trying to, and I say we, the money fund industry, are trying to find that out.
I just sum it up by saying our current state with this is um, a representation of additional and a recognition of additional distribution chains with enhanced use cases being a really good, sort of diversifier of who else might be interested in investing in money funds. It's a great opportunity for the traditional funds today with maybe some enhancements to them. But the future state, which is, it's more than months, but less than decades away. So maybe, a year, 2 years, something like that. This is something that can lead us into a type of product and a type of, sort of trading that becomes much more 24/7, becomes much more tied to partial days, not day beginning, day end, and is much more global in nature across currencies, across localities. We're not there. We're not even, thinking along those lines yet, but the opportunity to explore them as we are the beneficiaries of these distribution channels and client bases that are new and diversified is a great opportunity.
Excellent. Good discussion. A lot to watch, pay attention on here. Debbie, we see some changes in the industry asset trends. What's happening and how does that impact us?
Sure. So back to reality again, from the digital phase back to the, dollars in your pocket standpoint. These are dollars in the industry's pocket. So flows in 2024, grew in the high teen percentage wise, mostly due to retail consumers putting in additional cash into the money market funds. 2025, we've seen high single digit percentage growth, and it's been more of a mixture of both retail and institutional, and it's come across all three sectors of the business: prime, government, muni. Prime growing 16%, government 14%, muni 6%. I think when you look at the most recent industry data, Crane Data just provided some information showing the current industry asset under management of a little over $7.8 trillion. So I'm expecting, that 8 trillion. December is usually a very large inflow month from a secular basis. I can see where that 8 trillion for this industry is well within view for 2025. So that the rising tide lifts all boats, and Federated Hermes would be included on those boats that are experiencing these similar trends. One more, and then we'll switch it over to Phil. If we go on to the next slide, I just wanted to give you a little bit of information about the Fed and about the voting members and what's happening. It really is something that's causing consternation in the marketplace about whether or not the Fed, number one, today is independent, and number two, tomorrow will remain independent if in fact we establish that they are independent today. So, along the lines of why that's happening, you just look at this chart. Lisa Cook, who's under the dovish segment, second person in from the left, she, was under a lot of duress. President Trump attempted to fire her and have her removed from her voting membership on the FOMC, her governorship as an FOMC member. That was challenged by the courts. It was not upheld. This happened several months ago, and she has been defending herself since. But at the same time, also voting in the September, October, and next it will be the December meeting. At the bottom of that first line, you see under the dovish sector again, Stephen Myron. Stephen was a governor that came in back, I think it was 2 meetings ago. So he was in place for the September meeting. I believe he was instated the beginning of September, right after Labor Day of this year. His term will expire in January of 2026. And you might say, why such a short term? Well, he's replacing a governor who resigned, Adriana Kugler. And we, just found out about some problems that, I think her that was plaguing her as continuing as a governor on the FOMC. So she resigned early, which gave President Trump the opportunity to nominate and then have confirmed Stephen Myron. So controversy about him, about her, how that plays forward, and where that position goes in January of 2026. Right in the middle, centrist, you've got Chair Powell. His term expires as chair in May of 2026. We believe there were 19 interviewees for that position. We're down to 5 current ones, all of which seem to have, good credentials, would likely be, considered appropriate members and chairs of the committee. But again, may draw some concerns about whether there's independence going forward when one of them ultimately is nominated and becomes the next chair. Also, if you noticed, Chair Powell's term as a governor on the committee doesn't actually end until January of 2028. So he can stay on the committee. And I think there's at least a 50-50 chance that he doesn't leave. So he'll take up one of those voting spots, just not as chair at that point in time. And then ultimately you've got, four of the five regional bank presidents, everybody but John Williams from the New York Fed, that will also be replaced. So, I think there's going to be potential change, potential questioning of independence, but ultimately, from my own perspective, I have faith that the credentials of these FOMC members and what they're charged with doing for this country will continue to play out in an independent form, and won't rock the boat or rock what we're used to from an institution standpoint as we transition with them into 2026. So lots of controversy, but I think in the end it will work out just fine.
Thanks for the details and the analysis. That was excellent. Thank you. Phil, we'll bring you in now.
Thank you very much. We're on the next slide here, gross domestic product. We have at Federated Hermes a macroeconomic policy committee. Much like the Federal Reserve, we meet roughly every 6 weeks, 8 times a year, in order to develop a house forecast. Debbie and I are both members of that committee. And what you're looking at here is our effort from our last meeting in the middle of October to provide an update or a forecast on where we believe gross domestic product is coming. Importantly, we have a very constructive view. And in order to understand that view, we need to understand sort of the key components of what constitutes gross domestic product. The three core elements of the private domestic final sales component of the GDP is consumer spending, corporate capex, and the housing market. The three non-core elements are net trade, imports and exports, government spending, and inventories, liquidation or building up. So if we look at our third quarter of calendar 25 GDP estimate of 3.1%, that's a number that should have been released right at the end of October, but didn't because of the government shutdown. It will be released sometime over the course of the next few weeks. I think November 26th is the current thinking. We have a 3.1% GDP estimate, which is fairly constructive. Now, at the time that we put that estimate together, the blue chip consensus was estimating 0.9. We're at 3.1. Blue chip consensus at 0.9. They then revised their number up to an estimate of 1.3%. They then revised their estimate again up to 2.7%. So the blue chip is coming up towards us. The Atlanta Fed, for example, at the time we established our estimate, had a 3% estimate, which they've revised up to 3.8%, in which they have now revised up yesterday to 4.2% based upon the better than expected trade data that was released. So the economy, very strong second quarter, up 3.8%. The third quarter looks like it's going to come in strongly as well. Looking at the full year of next year, our 3% forecast, the blue chip consensus at the time we established the 3% forecast was at 1.5%. They have since adjusted their number up to 1.8%, but we're still noticeably ahead of the blue chip consensus. So the obvious question is, why is that? Well, let's go back to those key components of gross domestic product. On the consumer, we believe that the consumer is relatively strong, particularly at the high end of the consumer spectrum. The top 10% of America accounts for 50%, 50% of consumer spending, and consumer spending accounts for 70% of GDP. So we have seen very strong Easter and Passover sales at the beginning of the year, up 5% versus up 3% a year ago. the back-to-school season, June, July, and August. We don't know September yet because, again, the government's been shut down. But back-to-school spending in the first 3 months was up 4.2% year over year, almost double the 2.3% rate of growth we saw last year. Last year, Christmas spending was up 3.9%. We think the numbers are going to be a little stronger than that this year. And historically, those three seasons, the Easter Passover season, the back-to-school season, the Christmas season, have a very powerful positive correlation. The National Retail Federation recently established their Christmas forecast up 3.7% to 4.2%, looking at the months of November and December. We think the numbers might be a little stronger than that. But bottom line is that we think the consumer is solid. That accounts for a significant portion of GDP. Corporate CapEx is also very strong as a result of the 100% expensing provision that was included in President Trump's One Big Beautiful Bill, which was signed into law back in the 4th of July. We know that that productivity in the first quarter of this year was a negative 1.8% as companies pulled their CapEx spending plans off the board. When they saw what was going to be in the bill in the second quarter, they put their spending plans back on the board. Productivity in the second quarter was up by 3.3%. That's a significant delta on a quarter-over-quarter basis. And given the significant amounts of new investment that's coming into the U.S., both from here and abroad, we expect that strength in corporate CapEx, which accounts for about 20% of GDP, is going to continue. The third element is the housing market, residential construction, which typically accounts for about 5% of GDP. Housing has been in recession in 4 of the last 5 quarters. But as Debbie articulated so beautifully earlier, we expect that the Federal Reserve, with 2 interest rate cuts in the bank this year, may give us another cut in December, may give us a few more cuts over the course of next year. Lower interest rates, we believe, is going to help extricate the housing market out of recession and begin to contribute positively to GDP. So as a result, we've got a more constructive view on third quarter GDP for this year and full year GDP for next year, because these major components, we believe, are moving in the right direction. I think, Craig, we're going to hand the baton back to you for a polling question.
Yeah. And so if everybody would look to the polling question that's appearing on your screen, maybe behind things, go ahead and answer. It's a single poll question. How do shifting fiscal priorities and Fed policy expectations influence your 2026 planning? Significantly, moderately, minimal, and no influence. The results very much even on moderately to minimal influence, with a little bias towards significant. So I'm going to close that off. We're going to shift over, and Phil, if you would take us through the economic forecast. I know John's going to jump in as well, but if you could help
Absolutely.
us
So being that we established a stronger than expected outlook for the economy, 3% over the course of the next 18 months or so, we decided that maybe our earnings forecast for the S&P 500 were simply too modest. So if you look at the third line from the bottom here, S&P 500 earnings, move all the way out to calendar 24, you can see that earnings for last year were at $243. So as we ran through our earnings modeling with a more constructive GDP outlook, we took our earnings estimate for calendar 25 up from $260 to $270. In calendar 26, we went from $300 to $320. In calendar 27, we went from $340 to $355, and then initiated an earnings forecast for calendar 28 of $390. Now, those sound like big numbers, but what I've just told you is that we think that we're looking at a compound annual growth rate for corporate earnings of about 12% a year, which is not out of line given a 3% GDP forecast. Now the question is, at what level are we going to capitalize that earnings stream? And please flip ahead to the next slide. The argument that we had amongst ourselves was whether or not we were capitalizing that earning stream at the appropriate rate. Historically, we would utilize a more traditional Fed model or rule of 20 approach. And given benchmark 10-year treasury yield of about 4% right now, that would suggest a price earnings ratio of about 18 times earnings. But we challenged ourselves and said, look, there's been a dramatic transformation of the U.S. economy over the last quarter century, over the last half a century. And might that transformation suggest that a different approach to valuation is warranted? And so we took a hard look at that, and looking at the panel over to the left, that where we were back in the 70s and the 80s and the 90s, we were in a very lower growth, asset-heavy, manufacturing-based economy. Fast forward to today, and it's more of a higher growth, asset-light innovation economy, where manufacturing has given way to things like technology and healthcare and financial services. And so then we asked ourselves the question, okay, if that's true, then doesn't that dictate or require a different valuation multiple? And when we pushed the numbers on that, we came to the conclusion that a target PE of about 22 times earnings, given the current interest rate environment, more appropriate than a PE of 18 times earnings. So if you could just flip back one page and go to the second line up from the bottom, the target forward PE, you can see we plugged in our new PE of 22 times earnings there in 26 and 27. So in calendar 27, if you've got a 22 multiple on forward earnings of $390 for calendar 28, that translates to a target price for the S&P 500 of 8,600 by the end of calendar 27. Discount that back a year, that gives you a 7,800 target for calendar 26. Our target had been 7,500, so we moved it up to 7,800. Discount that back a year, 7,000 is the target for calendar 25. We had a target of 6,500, moved that up to 7,000. Now, just for point of reference, we hit the 69.20 level on October 29th, the day that the Federal Reserve cut interest rates, their last FOMC meeting. So I think we've recalibrated successfully market price respective to the stronger growth, the stronger earnings, and the appropriate capitalization that we're looking at. All right, please flip ahead 2 slides. So what does all of this mean from an investment standpoint then? How do we invest given the information we've just provided you? Well, starting in the upper left-hand corner, you can see that in the green, we've got a 5% equity overweight. That had been a 4% equity overweight back in the first quarter of this year. But then when the stock market dropped by 21% during the whole Liberation Day nonsense back in late March and early April, we decided to throw another log on the fire and took our equity overweight up from a 4% overweight to a 5% overweight down at about that 4,800 level. Stock market has rallied by about 43% over the last 8 months. So I'm delighted to say that was a good decision. The only bad decision, we should have thrown 2 logs on the fire at that point and enjoyed better returns over the course of the last 8 months. What sectors do we like? Well, the Mag 7 names have done phenomenally well. And we're thinking that there's going to be a reversion to the mean, a broadening out of the rally. That process has already happened. So we're not chasing the Mag 7 names at this point. We think that they're going to sort of tread water. The areas that we're overweight are the areas that we felt have been left for dead. The areas that have dramatically lagged that from a valuation perspective should enjoy significant catch up. And those areas are international with an emerging markets focus, domestic large cap value with more of a dividend focus, and the small cap names, both growth and value. Those sectors have already started to work. In fact, emerging markets is the best performing asset class of the year in the equity world. And that's a trend that we think is going to continue. So if we flip ahead to the next slide, we get to polling question number 3.
Thanks. That'll pop up on the chart. This is all that apply. Which areas of your treasury or finance strategy will require the most adjustment if policy conditions shift quickly? So we've got forecasting, investing, risk management, and different elements. So go ahead and fill those out. And that will be most excellent if you do that and submit it. You can see on the screen 45% for cash forecasting, short-term investing, liquidity management, 42%. Those are the two big leaders. The next grouping is debt or capital structure and risk management and hedging. And then it dips down to bank and counterparty diversification to really minor, not planning adjustments. Thank you, everyone, for sharing that. And Phil, again, I would love to hear you talk through this chart.
So this slide here, this histogram, is the mathematical proof of why we like what we like, which I discussed on the prior slide. The first two bars in this histogram look at the valuation disparity between domestic large cap value stocks and domestic large cap growth stocks. Historically, the value stocks would trade at a 36% discount to the growth stocks, but that discount right now is 49%. With substantially higher dividend yield. The two middle bars look at small cap versus large cap stocks. The small cap stocks historically traded about an 8% discount. They're currently trading at a 24% discount, 3 times that's normal. Again, going back to the idea of our expectations for lower interest rates, that will significantly benefit the small cap companies. Small cap companies typically self-finance. So lower interest rates will make it more affordable for them to manage their financing. Second, small cap companies will typically do 80% of their business here in the United States. The U.S. right now is the best performing economy in the world. They're raking. So the fact that these small cap companies are focused here from a business and operational standpoint is a huge positive. And then final point, as interest rates are coming down, that helps to boost a merger and acquisition cycle and an IPO cycle. And the small cap companies significantly benefit from this, particularly in the healthcare area. Think of it this way. As interest rates are coming down, the large pharma companies, think in terms of a Merck, a Pfizer, a Johnson & Johnson, are able to acquire small cap companies. Think in terms of very promising high growth biotechnology companies that have developed a cure for cancer, but may not have the resources in order to bring that product to market on a significant scale. So you've got a Merck or a Pfizer that will go in with borrowed money, purchase that company. It lifts the value of that company, and then other companies around it, with the benchmark having been reestablished, those valuations will rise as well. So lower interest rates significantly help to close that valuation gap with the small cap companies. The final two bars look at international versus domestic stocks. International stocks historically traded about a 21% discount to domestic stocks. They're currently trading at a 42% discount, twice the discount. The dividend yield on international stocks right now is 2.9%. The dividend yield on the S&P 500 is 1.1%. So you're getting more than twice the dividend yield, more than twice the valuation discount. One of the key drivers here is the relative weakness of the dollar. When the dollar is weak, international stocks typically do well, and our international colleagues believe that the dollar weakness has legs, particularly given our expectation that the Federal Reserve will continue to reduce interest rates over the course of the next year or so. Therefore, the valuation imbalance that we're seeing should mitigate itself over the course of the last year. International stocks have done very well this year. This is a trend that, again, we believe has legs over the course of the next year or longer. That's it.
Excellent. Thank you. Thank you so much, Phil. John's going to lead Phil and Deborah through a conversation dialogue about what are the takeaways. So go ahead, John.
Yeah, no, Phil, thank you. First off, Debbie, Phil, thanks for your time. Really appreciate your expertise. And Phil, I'm going to let you catch your breath because you've been speaking for the last 25 minutes, but I do have a question for each of you. So Debbie, I guess the first part is sort of as a recap to today's conversation, still 50-50 chance for some type of rate cut, but leaning towards not. And then still front-loaded maybe two, possibly three rate cuts in the first half of 26. So I guess the question is, if I'm sitting out in the field, should I be more concerned? What's going to sway us to a lower interest rate path? Is it going to be employment falling off a cliff, this if inflation still stays sticky, or I need inflation to sort of soften? What's my what's where do you think the Fed's eyes are in terms of where we should be watching, right?
Sure. And I think this was, addressed to some degree after the October meeting in the press conference by Chair Powell. The committee members are in a little bit more of a precarious place than they have been over the course of, most of the last several years. That being inflation going higher. So what do you want to do if inflation's going higher? You want to keep interest rates higher so that you are meeting or beating inflation and trying to drive it back lower. And then the other side, from an employment perspective, employment starting to soften. So what do you want to do if it's just employment softening? You want to lower interest rates to give the consumer a little bit better chance from a housing market, from a spending standpoint, all of various things that we talked about at the beginning of this webcast. But you can't do both of those at the same time. And when they're moving in opposite directions, I think what Chair Powell said and what we believe is that you have to address the one that's more problematic. So right now, if you've got, I think Chair Powell said from an employment perspective on a maintenance basis, you need 50 to 60,000 jobs growing per month. So right now, I think our run rate is about 64,000, somewhere in that neighborhood. We had an abysmal number of less than 20,000 with the revisions in August, a rebound number now in September of 119,000. Maybe that gets you to that 50 to 60,000. So you're lower than what you were for the last 2 years, where we were, nothing short of hundreds of thousands from a growth perspective on a regular basis per month. But but you're not critical. You're not in critical need. You're not falling off a cliff from an employment standpoint. No hire, no fire is the phrase that sort of maintains. It seems like in the Fed's eye. On the other side of the equation, you've got a Fed's target goal for inflation at 2%, and yet you've got inflation running at 3.5%, depending upon what measures we see. And we haven't seen any measures for a while, so heaven only knows what they'll be when we actually start to look at them again. But I mean, we did have the CPI, and that was for September, and that was actually a little bit better, a tenth better than it was expected to be, but still north of 3%, and yet I think anything at 3% for this Fed rounds down to 2. So maybe it's within its range as well. So I think you look to see which one diverges most first. Right now, I think we can be on a neutral path for a little while with inflation slightly above, but not that far above, and with employment slightly below, but not that far below. Maybe the Fed just doesn't, maybe it watches for a while. The path of interest rates clearly is still lower, but you don't have to get there next month. You don't have to get there next quarter. That path, we've already took a 9-month hiatus in this downward path, resumed that in September. Why not start a hiatus of another, a brief time for another brief time period where the Fed doesn't go in either direction. And that's, I think, our expectation at this point, that they continue to watch the data as it unfolds for what has historically been missed and what is new data going forward. And unless those trends start to break out for employment or inflation on either end, either of the bad ends, they just watch it evolve for a little while to see which one becomes the more concerning picture.
Okay, that's super. Well, Phil, I think we have a minute before Brian gives us the hook. And I know I have a question that won't take a minute to answer, but where's AI fit in this whole conversation? It's not a 1 minute
Well,
answer, I know, but
yeah, no, I was asked that question on a client call earlier today as well, and there are some aspects of the U.S. economy. I'm thinking perhaps law firms or investment banks, where some junior positions that used to be very data intensive, maybe AI could assist there and reduce the need for headcount. But there are other jobs within society, agriculture, construction, hospitality, child and elder care, just as four examples. AI is not going to babysit your kid or put a roof on your house or pick fruit in a field in California. So there are certain jobs that are still going to need human input, and other jobs that will be able to economize and boost productivity.
Webcast host, right, Craig? That's not going away.
Who knows? Who knows? Well, thank you, John, Phil, and Deborah. This was a good discussion. I sort of wish we had more time to explore these topics, but thanks so much for the insights. And thank you, everyone, for joining. I will turn it back to Brian with some final announcements and opportunities.
Thank you, Craig. Thank you, Debbie. Thank you, John. Thank you, Phil. And thank you, everyone, for joining us today. The CTP and FP&A credits, today's webinar slides, and a recording of today's webinar will be sent to you within 5 business days. And for more on the future of the Fed, be sure to listen to the Treasury Update podcast, episode 385 with Federated Hermes by clicking the link in the chat box. Thank you, and we hope you have a good rest of the day.